Hi, I'm Nigel Baker, and you're listening to The Future Financial Advisor. We're running this podcast to create an avenue for advisors to share their thoughts and their best interests, and really trying to attract those advisors who want to take the industry forward. What we want is great businesses who are really making a difference and really making a big impact to their clients, and we want to know how they're doing it. So in this series, we're going to be discussing the latest digital platforms, some best practices, evidence-based investing strategies. We want to give financial advisors the tools they need to help more investors improve their financial well-being. So if you're ready to take the industry forward, modernise your advisory practice and reach a new generation of investors and the new generation of advisors, then this show is for you.
So all our recordings and podcasts are general advice. All the content, all the people interviewing here, it's all their own opinions and all their own views. In no way does it constitute any personal advice or recommendations. If you need specific advice, please go and seek an advisor. Thanks very much.
Hi, it's Nigel from CNTM here. We're here to review the quarter that's just passed. It's 1 July 2022. I'm very grateful to have Dr. Steve Garth with us today, who's going to run through what's been going on in world markets. He's got decades of experience in managing money. So big thank you and welcome, Steve.
Yeah, thank you, Nigel. It's great to be here.
What a quarter it has been. A lot of things have changed since the last time we did a quarterly update, where things were looking sort of rosy, but we're starting to see a few cracks. So today we're going to go around the different asset classes. Steve's going to give his view on what's been going on. And for clients listening to this, obviously a few concerns out there, lots of media and press. So we're going to try and put all this into perspective, give you hopefully a bit of comfort that what we're seeing is actually fairly normal in investment markets. No one likes it when it happens, but we've got the great expertise here of Steve, who's been in the markets for a long time managing money, and will hopefully give us some great information that's going to definitely give us some great information that's going to put us all at ease and make us understand what's going on. So, thanks, Steve. We're going to start.
Yeah, thanks, Nigel. Well, look, I've certainly seen quite a few market downturns and recessions in my time. So what we're seeing at the moment is not new. It won't last, and everything will be all right. Let's just start by putting it in perspective. Over the last 12 months, certainly in the second half of last year, things were quite rosy. The Australian market was up 3.8% in the second half of last year. And even in the last quarter, the March quarter this year, the Australian market was up 2.2%. And of course, that was sort of defying gravity because every other market was negative in the first quarter. Well, the world has caught up with Australia, or Australia's caught up with the rest of the world, because all the markets are down this quarter, as I'm sure you know. The Australian market, it's down just close to 10% for the quarter. And when we go to overseas markets, the world market ex-Australia also down about 10%. The emerging markets, surprisingly, are only down a little bit by 1.7%. And the reason why I say surprisingly, the emerging markets have really had the worst performance over the year. They're down 25% for the year. So what's going on in this quarter that they're only down a little bit? It's all got to do with China. China makes up about 30% of the emerging markets. Over the year, China's down 25%, but in the quarter, believe it or not, China's up by 12%. So Nigel, it really speaks to also diversification. Not all markets behave the same way. Now, the other markets we should talk about, because you hear about it in the news all the time, it's the two major US markets, is the S&P 500. That's been down as far as 20%. From year to date, and that's what they call a bear market. Technical term is a bear market. The market's down by 20%. And the other market, the NASDAQ, which the viewers might be aware of, that's where the big high-tech stocks reside, that's been down as much as 30% year to date. So they've really been hit hard. But just to go back a little bit, up until December 2021, we're in one of these great bull markets from March 2009. And over that time, the US market made a total return of 780%. In fact, the Australian market was up 280% over that time. So these market downturns, not that unusual, and you have to keep in perspective all the good times that we've had leading up to this. Anyone who's been invested, for more than a year, 2 years, is still in positive territory.
Yes, so volatility it's a very common occurrence in markets. I suppose what clients are seeing, that they understand when COVID happened, there was a severe drop and a bounce back, and perhaps that was a bit of a blip. Now we're seeing a real economic perhaps downturn where there's talk of recession. You'll go through that in a bit more detail later on about what some of the indicators here. But what should investors be thinking about? They're seeing all asset classes fall at the same time. Superannuation in Australia has been around since the early 90s. I think this is only the fifth negative year. We're going to see a negative year for sort of the balance type funds. So what should investors be thinking about? It's not a nice time when you see every asset class go down. Diversification is a great concept, but when every asset class falls at the same time, even in property, what should they be thinking about, and how can they, I suppose, be put at ease that things are going to be okay?
Yeah, so I think going back to some of it earlier, Nigel, it's not uncommon to have market downturns. Even in the bull market I talked about, there were, every year or two, there was a significant downturn in the market. Now we are seeing a major downturn here across asset classes, as you say, but again, it's not that unusual. And we've got some data here, Nigel, too, that says after market downturns, it only takes 1 to 3 years to fully recover from that. In fact, to have much stronger returns than what the downturn. So if you look at the chart here, it's a little bit complicated, but when markets were down by 10%, then within a year, markets were already positive. When markets were down by 20%, once again, within a year, they were positive. Within 3 years, they were more positive. 5 years, great returns. And even when markets were down by 30%, it took a little bit longer to get that recovery, but you still had positive returns after 5 years. So the data says that don't get too worried by a market downturn. It's not unusual, and markets recover quite quickly from it.
And one of the positives of this we're seeing as well, Steve, is that for the retirees, and when we've been doing income projections the last couple of years, we've had cash rates at near zero. We've been really relying on the growth assets, the property and shares, to generate all the income from the portfolio. Now we're seeing term deposit rates back at 3, heading towards 4%. Not good for those with high debt, but we're starting to see the income from Australian shares, even though the market's down, that's still going to be positive. In terms of the dividends are still going to be paid. There's no threat, especially under the widely diversified portfolio. So actually projections for income going forward are looking really good. And someone with a super fund now can be expecting much better cash flow over the years ahead. So it's not all bad news.
No, that's absolutely right. And just on that, Nigel, we'll just move to bonds for a moment. It's not everyone's favourite topic, I know. And you may remember in our quarterly update last quarter, it was the bonds were the headline figure. It's the bonds took the caning first, and while the equity market kind of looked on, well, it's odd. And second quarter, it's the equity markets that's taken the caning. Bonds are still a little bit negative this quarter. When you have a look at the chart we've got up now, you see those bond yields. When yields go up, then that's when bond prices go down. But you can see that in the last month, those yields have turned around and started to come down again, which means bonds have had a positive return in the month, starting to recover. Now, to your point about cash flow, I'm sure everyone knows that a year ago, bonds were returning about 1%. There was not much income out of bonds. Bonds are now returning between 3 and 4% going forward. So bonds too will recover from that down market they had. And what we're seeing here too, Nigel, is as the equity markets fall, and there's lots of talk about a recession, which we'll just speak a little bit more about in a moment, but bonds are also starting to perform their classic role of the bonds are there protecting the overall portfolio. So while bonds took the caning earlier on, you can see they're now having positive returns as the equity markets are having their deepest negative returns. So I'll just say a few things on recession because it's a scary term.
Yep. What is a recession?
Well, first of all, what is a recession? So a recession, technically, it's 2 quarters of negative growth. So it's an economic term.
Yep.
What does it mean for the average person? Well, it can mean different things. Often there's unemployment that goes with a recession. It's a slowing down of the economy. Of course, it slows down inflation, which is really what central banks are trying to engineer. So recessions aren't great, but once again, they're not uncommon. The last recession was during the COVID pandemic, and of course that was very short, but came out of that within weeks. Now, for all we know, because recessions, looking backwards, it's an economic term, we may well be in a recession. And the fact that the stock market has fallen this quarter, the stock market is forward-looking, so the stock market may have already worn the pain. We don't know that the stock market's going to keep falling down. The recession may not happen for another quarter, another 2 quarters, but that doesn't mean the stock market will fall further. The stock market and the economy are two different things. So the economy looks backwards and people are saying, well, I think we're heading into a recession. But the stock market is looking forward and going, we've already priced that in and now we're looking to the future. And so you might see that the stock market goes up, even though we may be coming into an economic recession.
Yeah, it's interesting. Previous recessions have been aligned with higher employment. This recession seems to be driven by higher interest rates, and people obviously, and there's some supply shortages due to COVID and due to things like that, but we're not really seeing the unemployment that we would have seen in previous recessions, so that's a little bit different. Perhaps that's coming, but at the moment, there's unemployment at record lows.
At record lows, yeah. We were essentially technically in full employment. So you're absolutely right. We may well be in a recession, but it's a different sort of recession because we're not seeing the effect on unemployment at this stage. And not that central banks want to create a recession, they certainly don't want to do that. But at this point, what they do want to do is they want to get inflation down. And a way to do that is if the economy slows significantly, and in a way that's what they want, the economy to slow down gently, but you can't engineer that. And so if the economy slows down too quickly, that's the recession. But you make a very good point, Nigel. Typically recessions are high unemployment. There's no sign of that at this point.
So going forward, we're not going to forecast, but there are perhaps some things on the horizon that are concerning people, but perhaps some things that they can get some comfort from to say, look, markets do this. Luckily, it's not very common, but when it is evidence and that there's a lot of media that's going to create a lot of hype, but again, we'll remember they're looking backwards, they're reporting on what happened the last quarter. The next quarter could be great, it could be flat, it could be negative, we don't really know. But again, the main fundamentals of no major need to massively change investment strategies. One thing that's been really important through this cycle is by diversifying, by not having high exposure to a few tech companies or risky assets that have come to the market that people don't understand yet. We've seen those markets really capitulate, but thankfully, we don't invest in things that are, crypto and those sort of things. So really, it's not much fun seeing portfolios negative for a calendar year. When we look at the big picture, the average returns of our sort of model portfolios are still in the 8-9% over 10-15 years. And we'd expect that. We don't know what the future holds, but I don't see any reason why we wouldn't expect that for the next 10-20 years.
No, that's absolutely right, Nigel. It's not a pleasant period when markets are turning down and talk of recession. Remember, the media is always going to focus on the negatives. Media's never say, look, everything's going to be sweet in the next couple of months. So try to tune out the media. Remember to stay disciplined. You're in a diversified portfolio. And when you look at the long run, as Mike was just saying, put the chart up here, markets go up over the long run, but they don't go up in a straight line. And what we're seeing here is a wobble. It's unpleasant. Hold tight. Everything's going to be okay.
All right, so to summarise, Steve, from today's session, for the message for investors is, yes, these are slightly worrying times. We haven't had a negative year for some time, but this does happen. Don't panic. We're here to talk to you. From today's session, you would have got a lot of insights from Steve's experiences. This is quite a normal occurrence, how markets respond. There are fears of recession in the media, but again, you've got to really stick to what we can control, stick to your asset allocation. Make sure you've got enough cash and fixed interest. There is some good news on the horizon with cash rates going up for retirees. So again, thanks so much, Steve. Really appreciate your time today.
Thanks, Nigel.
You've been listening to The Future Financial Advisor. So if you've been enjoying the show, please make sure to share it with your network and leave a review on your favourite listening platform. Or if you've got some ideas or thoughts or would like to come on as a guest or know someone who would be a great guest, then please let me know. To learn more about Scientium, just go to our website, scientium.com.au, or look me up on LinkedIn. Look forward to speaking with you and see you on the next episode.